Good evening, gang. I loaded this up a little bit early, so please give me a minute or two while I load everything that I need to get ready for this. Wasn't sure who would be on here yet. Oh, how did everybody do today? How did we have a good day? Good days across the board? Anybody in the chat? Decent day? No trades, any trades? Futures getting a little downside at the moment. Okay, shift this. Decent, yes, solid, didn't trade today, plus 1.8. Nice, Robert, hell yeah, didn't trade, good day, scalped and video calls. Nice, so good days across the board, nothing too crazy. Need Amazon for, yeah, that Amazon put spread would be nice. Well, Rick, you're in the right place, and I would, if you've exactly right, you're in the right place, and there's no need to rush back into trading. Like we've talked about before, I think that one thing that is universal between all of the mastermind students is that everybody wishes that they had been a little bit more patient on, learning the system and then deploying their capital once they know the system, right? Once they understand the system behind all of the trading that we do, right? So with that, let me post in the mastermind section that we are getting started. We are getting started, team. Two little notifications just for you all. At some point in the next few minutes, I have a delivery from Bed Bath & Beyond. They messed up my previous delivery and I have a blanket that's coming, and there's a small chance I need to go outside very briefly to get that. I'm sorry, it's poorly timed. And then the other point is that at some point during this call, I'm going to order my dinner so that it gets here after we're done and we can watch the end of the finals game. All right, but those are just the only two. I have it all loaded, so I just got to press send. Those are the only two little notes for the day. Other than that, I'm very excited to dive into lesson 2 with you all. All right, so with that being said, let's go ahead. It's lesson 2/3. We will go ahead and sort of pick up where we left off, which was talking about risk, right? Where we left off last is that we were having an in-depth conversation on how we as traders, and when I say we, from now on, I'm speaking about myself and I'm including you all because I want you all to trade the same system as me going forward, right? I don't want you to deviate from it, at least for the most part, right? For the most part. So we talked a little bit about general rules, right? Capital usage versus actual risk to your end account. Talked about handling emotions, a little bit with risk. We'll talk about that a little bit more tonight. And then we'll also dive into swing trading, position sizing, and how to manage a small account, right? We want to make sure that we are covering a small account game plan for you all so that you can have some sort of structure to your trading. I think that's going to be very, very important. So with that, sorry, I see someone saying I was literally waiting for a new link to be posted. Yeah, I'm sorry, Kendall. I apologize. I thought we had cleared this up last time. I posted a link earlier this morning and said, hey, here's the link. And then about 30 minutes ago, I said, I'll see you all in 30 minutes. And it was just the link from earlier about. So it's not the same link from the previous classes. This is a new link. And this is a new link that I put in. Okay, please excuse me all for 1 second. Sorry, people. This is that call I was saying might be coming. All right, I apologize. That was the worst timing of all time. Sorry about that. Quite possibly the worst timing of all time, but we're now only 2 minutes late and we started a few minutes early. So Kendall, let's clarify that just again, just so we're all on the same page. What I'm going to do, what the standard will be is that each day that we have a class, I will try and post a Zoom link like earlier in the afternoon at some point, and that's the Zoom link that you'll have. It's not the same one that we used on Tuesday. It's a new one, but it's in the same area, mastermind updates. So it'll always be there. You can always find, it'll always be in that same section. And then if you can't find it or anything, just tag me in the mastermind chat, tag me a few times, and I'll see the tags that I have Discord pulled up, and we'll get you in there right away. All right. So let me take a deep breath. Got my new blanket. It's poorly timed, but thank you, Bed Bath & Beyond, for not scheming me out of a blanket. All right, with that being said, yes, Rick, you will have access to all the slides. They're actually already loaded. So what we'll do is we'll get those posted as we go through each of the lessons. So yes, you will have access to all the slides. All right, okay, team, I'm gonna turn off the questions box for a little bit, just so that I don't get distracted. Remember, we will have an opportunity to talk through any questions that you might have. But with that, let's dive in. Let's start talking about what we are going to be covering tonight, risk, and then a little bit later, we will be talking a little bit about what's called the loop and how to avoid that and get out of it. And then we'll dive into the beginning stages of technical analysis in our offensive system, as what I call it, and then dive into the charts a little bit and talk more about the NVIDIA trade today. Yeah, so let's do it, okay? All right, with that, let me have a sip of water. So we talked about this yesterday, right? So we're just going to run through this again very quickly, right? But we want to be the casino, right? People often compare trading to gambling. We don't want to be the gamblers. We want to be the casino, right? Which means we have an edge, which means that we have good risk reward. We are risking 1 to make 3 on all of our trades, right? And how we find these good risk reward situations is we use our technical abilities to give us that edge, right? Then we talked a little bit about the difference between capital users versus end risk, but really what this comes down to is that you have to be able to remain disciplined above all else, right? You can use a larger percentage of your account and have a tighter percentage stop loss so that you don't have to only enter contracts with 3% of your account and are limited to very small contracts. You can use bigger contracts, but you have to have tighter stops. Right, so this should all be reviewed, just kind of covering what we talked about yesterday. Hopefully this is all familiar with everybody. If not, please go back and review lesson 1, right? So again, my general account risk rules is that I manage my account as if I have $100,000 in there. I risk about 1 to 3% per trade, with the absolute max being about 10. And I try never, in no world would I ever lose 20% of my account on an individual given day, even though I'm trading my account like aggressively, right? Very aggressively. The other thing I talked about is that I use withdrawals for safety. And I think this is a huge part of what I do. So if you are unclear about that system at all, I encourage you again to go back, and we'll talk about that a little bit more tonight as well. But understanding that withdrawing your profits is a giant portion of trading, right? So again, we've covered all this a little bit already. So now let's move into, this is where we closed up our last one, right? Which is I want to talk about, or actually, no, excuse me. I do believe, okay, well, we'll cover this slide again. I'm not sure if we talked about this one last presentation or not, but I want to talk about my general rules of trading. And the beginning part of this presentation is a little bit risk related, but it also is very psychology based. Because to me, if you know me, if you've been following me on Instagram, which all of you have, you'll know that in my opinion, the hands down most important thing that you can focus on as a trader is your psychology, right? So it doesn't matter what kind of risk management rules and principles that you have in place. If you're not following your rules and you don't have the right psychology and emotions and emotional aspects going on while you're in those trades, your risk management rules don't mean shit, right? Like, does your risk management rules really mean anything if you end up going on tilt and having like a really crappy day? No, they mean nothing, right? Like, it really doesn't mean anything. So you have to, in order to talk about risk, it's incomplete without talking about the emotions that go along with trading, right? So there's 3 big sort of pillars I want to talk about here that come with handling emotions while you are in trades and while you are planning to enter trades. The first one is accepting the risk. And I think that there's almost some part about this that kind of bugs me, because signal culture, there's a lot of things that bug me about signal culture. And all of you have full access to the Discord. So yeah, you see that I post signals and we have a bunch of analysts posting signals. So part of me feels like a little bit of a hypocrite, but my literal goal is to change signal culture within the trading world, right? Because one of the parts of signal culture that I hate is that gurus always tell you, you can't trade with money that you're attached to. You got to be completely detached from the money. You got to be totally okay losing the money. And to me, that's like an excuse for their bad trades. And like, because like no one, in reality, yeah, I'd love to have all of the money in my account mean nothing to me, but like, what? No, like everybody's account, the money in there means something to you. And if you lose it, it's a big deal, right? Now, that being said, I completely agree with the fact that if you have $5,000 to your name, your trading account should not be $5,000. It shouldn't even be remotely close to that, right? I completely agree with that part, but I hate the part that people say you have to be so emotionally detached from the money that you don't care if you lose it. It's like, what the fuck do you mean? Like, it's my money. Why? I don't want to lose it, right? Like, what? I'm not okay with losing it, right? Like, and that to me kind of puts this mindset in your head that it's okay to fail, right? Now, that in and of itself is extremely different from the point I'm going to make now, which is that it's true. As a trader, you do have to accept the risk. At any point in time, the money that I have in my Interactive Brokers account tomorrow could be at zero. I could go on a massive tilt, trade 0-day SPX, and they go to zero. And next thing you know, at the end of the day, I'm looking at my account like, what the fuck did I just do? That's a threat at any point in time, right? But beyond those sort of crazy moment tilts, you have to accept the risk of trading is that you are going to lose money, right? What plagues most traders more than anything is the fact that they refuse to admit when they're wrong. They refuse to sell things for a loss, right? Because it's the loss, it's being wrong that really hits them hard, right? They don't want to lose any money, they want to be wrong. But in reality, we have to accept as traders that we are going to be wrong, right? So as soon as you enter the trade, you should be blatantly aware that, hey, if I'm risking $250, if I lose $250, that's cool. What's not cool is losing more, averaging down, stuff like that, right? So accepting the risk is a huge portion of trading and one of my big general rules. But I want to deter you away from the people who encourage you to say, your money is, you got to treat your money, you got to be completely emotionally detached, not care if you lose the money. It's like, that's just not realistic, right? Like, it's super not realistic, especially for a smaller account going their account, right? So I agree with portions of that statement, but I hate the way that it's been twisted and turned into an excuse for people to lose money on signals, right? Like, that's what I hate, right? And so for me, sorry, I went a little bit of a rant there, but to tie it back all into this first pillar and rule is that as soon as you enter the trade, you have to accept the risk that you might be wrong, right? You could be wrong. And if you don't accept that in advance, then it really doesn't matter what risk management principles you have, because at some point you're going to go until break your risk management rules and blow your account. It's just a fact, right? If you can't accept the loss, and you always have struggles closing your losses when you plan to close them, it doesn't matter if you're making money in the temporary time. At some point, you're going to go until blow your account. It's just the truth, in my opinion. It really is. So you have to accept that risk in advance. So the other thing we talked about a little bit last time, and again, we might have talked about all, I forget if we ended on this slide or this slide before, but even if we did, and I see some questions popping up, they might be telling me we talked about it. I'm phrasing stuff differently. this is all worthwhile and worth covering again, right? But being a good sport, when I do feel like we definitely, we mentioned last time, because I remember making that analogy, right? Is that we can't be, when you win, you have to be just as good of a winner as you are a loser, right? So we won't cover too much on this one, but that to me is an analogy that like not enough people use, because everybody will understand it, right? Everybody will understand that you have to be a good sport as a trader, right? If you go into a day and you end up taking a big loss, don't be a poor sport blaming it on everybody else or blaming it on the market out to get you or the fake outs or the charts. Sometimes setups fail and we have to accept that, right? So then the last one, the third pillar, is never forgetting who is the fucking boss, right? Right? Like, are you working for the market or is the market working for you? If you feel an obligation to wake up every single day and trade, even when you're on vacation, even when you have, families in town, something like that, if you feel obligated to wake up and trade and do it no matter what, then you're not the boss. The market's in control of you, right? And again, that will lead you to breaking your risk management rules at some point, right? So as hard as it is, because especially, this is the part of Discord that I don't like, is that when you're in a Discord channel, especially when you're paying for one, you feel like obligated to trade every day to make money back on what you're paying for. And also you get some FOMOs from other people in the room making X or seeing their profits or whatever the case may be, right? So I think it's really, really important to understand and to drill it into your own brain that you are the boss. And until you take it seriously, right? And until you act like the boss, and act like you don't need to trade, then you're constantly going to be putting yourself in jeopardy of breaking your risk management rules and going on tilt, right? So these are my 3 pillars: accept the risk, be a good sport when you win or lose, and figure out who's the boss? You are the market. Because if you're not the boss, you need to switch your perspective and your thinking in order to become the boss. Okay. All right. Let me check the chat real quick. I love you all having fun in there. All right. So with that, now let's talk about a few bit more specific things. We're going to dive into small account game plan here. But first, I want to talk about swing trading positioning sizing. And I think this might hold a little bit true to some people who took some overnight swings today. For me, as a trader, there are some defined rules that I have when it comes to swing trading, right? I am primarily a day trader. I don't mind swing trading, but there's some very defined rules that I use in order to execute on any of my swing trades, right? And especially with how do I position size those swing trades. So the further the expiration, this should go without saying, but the further the expiration, the safer it is to use a larger size, right? Like if you compare my Duke's overnight NVIDIA trade last night compared to Joel's AMD trade, I think you would have been safe to put in, 2 or 3x the capital in Joel's next week trade, just due to how the contracts would be significantly less volatile, right? They have that much more time premium on their hands. It's safer to use a larger size, right? The other thing that comes into play is your price target or stop loss, which then ultimately translates to your risk reward, right? What is your risk reward? If you can find a swing opportunity that has a higher probability with a 1 to 8 risk reward, then yeah, it's worth sizing that position up a little bit as long as it's still a high probability type of setup, right? So again, that's where number 3 comes in, is the setup and quality and probability, right? If I'm holding, for example, I decided to participate with Chipper on those Amazon puts, which this is not a common trade for me because that daily chart is a long, not a short. But for me, Chip's been hot. He's been hot. I'm sure he's got some sort of rationale. So I put in a very small size to that, like $450 or something like that, right? And to me, that's a lower probability setup. Risk reward is a little bit lower, at least from my trading style. I don't know what his particular style is. Then that's lower probability, and I use smaller position sizes, right? Again, this kind of translates right into our next portion here, which is on weekly expiration swings, right? Anything that you're holding overnight on a weekly literally has to be sized for 0. It has to be, because weeklies are fucking nuts and anything can happen at any point in time, right? Again, pardon my French, I swear, I try not to swear a lot, but I've been swearing a little bit more recently. So if you're holding anything overnight, you must be prepared for the possibility that it could go to 0. And if it does, and that damages your account, that's on you, right? Because you made a decision to think, oh, I can get out for, and that's, let me start this by saying that you can mentally prepare. I'm not talking if you're like following a signal or anything. I'm talking about you and your own trading, right? I don't give a shit about any of the signals you all follow because I'm trying to teach you all, for the rest of your life, right? So if you are going to put some sort of cash into any weekly position, weeklies are nuts. And if the stock has a gap down overnight or a gap up if you're short, those can go to 0 no matter what, right? So I'm not saying that you have to be preparing for that and assume that that's going to happen, but it's hard because on a weekly swing, you can't necessarily say, oh, I'm going to use a 20% stop loss. It's like, well, what if it gaps down and you're down 50% at the open, right? Like you can't prepare for that kind of stuff, right? So anything overnight must be sized for 0. I'm not saying that you shouldn't hold weeklies overnight. I did it and I made a lot of money last night from it. But if it had gone to 0 last night, I'd be okay with what had happened, right? Like I'd be fine with what would have taken place, right? So anything weekly, you have to be sized for 0 because they're susceptible to higher levels of time decay and IV changes. So they do have a lower initial cost, which is nice because you can technically have lower risk on by having less dollars in play. But you have the higher volatility risk that can really come sort of haunt you, right? It can haunt you. So for me, it's kind of crucial that we cover this, especially as the market tries to flip into a circumstance where we might consider more swing trades. Then it's crucial you understand sizing on this because we are also not out of a weekly downtrend in the bear market. So keeping your sizing in check on swings is huge, right? So anything weekly, you got to be prepared for it to go wrong. And if you're not okay risking a normal size dollar value contract on something like that going wrong, then look into debit spreads. And the beautiful part is that'll be less than 5 and 6 for us. We're going to get right into that, right? So we'll all talk about that. And the other thing, the other thing that I want to speak out before we move on from risk a little bit is a small account game plan. Because I don't know about all of you. I know actually some of you have bigger accounts than most. some who did the previous mastermind, I should say. But I know there's a good chunk in here who are working with a small account, right? Small account can be anything. There's no hard definition for it. Some people might consider 5K a small account. Some people might consider, 2,000, 1,500, 2,000. For me, the number is about 2,000. 2,000 to me is the good starting basis number account. If I told somebody that even if they had money, right, like they have a decent net worth, I would say start trading options with $2,000. That's the round number you can use because that allows you to manage risk well. If it goes completely to crap and you lose $2,000, that sucks. But it's also not like the end of it shouldn't be the end of the world for anybody with a functional job, right? So I think that, but it also allows you, $2,000 is enough to allow you to manage risk, right? And that to me is like the crucial part of being able to succeed as a small account. You have to be able to manage your risk, right? So let's build a specific game plan for you all who have about smaller accounts and figure out how are we going to have you grow your accounts and then protect those profits. So step one is that you got to have two separate accounts, in my opinion. You got to separate it, right? Or you got to pick to only day trading or only swing trading. And this would be a hard market to only swing trade in, right? You got to have a cash account for your day trades and a margin account for your debit spread swing trades. Now, the nice part about debit spreads, and again, we'll talk about how to use those all as we get into that particular lesson, but debit spreads, you can literally take positions for $30 and be like, you could take a SPY at the money position for $30, risk 30 to make 60, right? Or risk 30 to make 70. Like those are real positions. And $30 of a swing trading account is actually like a reasonable risk for a $1,000 swing trading account, right? If you have $30 in an overnight spread, right? And again, because it's an overnight and it's a weekly, right? We have to size for zero. So if you're on $1,000 swing trade account, you really can't, and you're treating it like a real account, right? You're not just YOLOing it. Then you really can't have more than like $50 to $70 max in one individual given trade because that'd be 5 to 7%. And we have to prepare for the chance that it could go to zero, right? Just on swing trading accounts. We'll talk about how we do this differently with day trades, but your swing trading accounts. So for me, if you're looking to participate in some of the swing trades that we have posted in the room, or more importantly, once you start finding those setups on your own, you got to have a margin account for debit spreads. And honestly, Robinhood is fine for this. Ali uses it, Jordan uses it, I use it sometimes, right? Ron uses it, like Mike, I don't actually, Mike might not, but pretty much everybody uses Robinhood for a small spread account, right? You just got to be aware that the fills might not be all that great sometimes, right? So I would separate you. From what this also allows you to do is not have, it's like separation of church and state, kind of like we talked about a little bit last time, but this is a different example of a separation of church and state in the sense that your spreads and your overnight trades are not going to affect your day trades and potentially put you on tilt. Remember, everything I do is about keeping you all off tilt, right? And if you swing something that goes wrong and it's red at the open in the same account that you plan to day trade, and then you day trade it, right? Or something like that, right? It's very easy to be like, oh, I need to make back that swing loss, take a bigger size on your day trade. Next thing you know, you're down 30% of your account in a day, right? So for me, separating these two is huge. It's giant, right? It's a necessary thing for me for separating swings and day trades. So some other rules that I would have for a small account is that I would want you to have 30% of your account exposed at any one time max. Meaning that if you are in, and if it was a swing trading account, I'd actually decrease this a little bit even more. But if you have $1,000 account, right, that means that at any given time, I would want you to have $300 in positions overnight, meaning that you have at least $700 cash. Not that you can enter new positions with, but that you can't fuck up. Pardon my French. You can't touch it. You're not allowed to. If your other positions go wrong, you still have that 70%, right? That's huge to me. And the same rule applies on day trades. In my opinion, the same rule applies on day trades, right? So if you have a $2,000 account, which is what our baseline is for these day trading cash accounts, right? A $2,000 account, that would mean at any one time, the absolute most that you are using in a position is $600, right? Please tell me I didn't get that math wrong. 30% of 2,000 is 600, right? I think someone double check my math. Yes. Okay, cool. All right. Sorry, I'm checking these right now. Kendall, I also see some of your questions and I'm not ignoring them. I'm just trying to keep the flow of this presentation. So also don't hesitate to save some of these. And Mike, you're a homie for being on here, but I also just don't want to ask too much of Mike, but don't hesitate to save some of these and post them afterwards or tomorrow when we have the Q&A as well. I just don't want you to feel like I'm ignoring you or anything. Okay, cool. We're all good. Okay, let me close that. Okay, so where we're at. Okay, so for me, I was checking if my math was right. $600 is 30% of 2,000, right? Right? Yes, it is. Okay. So for me, that would mean that if you retire a $2,000 account, the absolute most you can have in one position, or preferably it'd be across two different positions, would be $600, meaning that you have 70% of your account safe in case something goes wrong, right? And within this exposure rule, I want you to have a 5% max account risk in any one position, right? So let's say, and we can even insert a text box here, but let's say you have, $2,000 account, right? You take a $500 position, stop loss of 20% equals $100, right? If you are risking, you have $500 in your position and a 20% stop loss, you are risking $100, right? My rudimentary math is correct. That is 5% of a $2,000 account. So that is your absolute max, right? And given our 30% rule, technically you could use a $600 position size with about a 15% stop loss. And I think that would also come out to about $100 or give or take. Math is hard. Math is not my best, surprisingly, I'm a day trader. But regardless, the absolute max that you're being willing to risk on any one trade is 5%. That's high. I would prefer it to be a little bit lower, but with a $2,000 account, $100 risk is actually okay with me. It's reasonable. I prefer it to be like 50 to 75 if you can swing that. But this is an absolute max, right? Like if you have an A++ setup, I'm okay with you using $600 of your $2,000 cash account in one trade, as long as you have an entry that gives you a tight stop, right? Again, the most important part about using a larger percentage of your account with a tighter stop loss is actually fucking following the stop loss, right? Like that's the hardest part, right? Like if everybody could do it well, then everybody would just use 50% of their account and any individual give a trade as long as they can follow their stop, right? So following that stop is a huge portion of this. So for day trading, I want you all to have some goals as a small account team. For those of you who are small accounts, I know that doesn't apply to everybody. However, these rules, I should have mentioned this earlier. While I made this presentation with small accounts in mind, literally everything I'm saying is applicable to all account sizes, right? It's applicable to all. I just custom tailored some of these examples to use a $2,000 account. I actually would say if you are trading your account, the traditional way, like for me, if I was trading it the traditional way, I'd keep $100,000 in there. These would be the exact same rules that I would follow, right? It's just a little bit different the way that I do it that I mentioned with we talked about that a lot in the last lesson, where I keep trade with less, but treat it like more. If you have a $2,000 account, you just don't have the luxury to do that, right? You just don't. So you need to have a hard set of rules in order to go about it. So some sort of goals that you should be attaining is that as a day trader with a small account, I want your emphasis to be on literally 1 to 2 good trades a day. I want you got to be a hit and run trader until you can build up profits. The more you stay at the desk, the more likely you are to overtrade and give back your gains, right? So if you are a day trader and with a small account, 1 to 2 good trades a day. Again, that same thing applies to a bigger account, to me even with a large account, but it applies very specifically to smaller accounts because you just don't have a whole lot of bullets, right? You just don't. $2,000, a few mistakes, a few tilt moments, and you just don't have a whole lot of room. So you have to be even more disciplined than anybody else, right? Along with that, I want you to focus on a group of less expensive stocks with less expensive options, and we will cover those next slide. So for swing trading, we talked about this a bunch already, but I want you to utilize spreads to capitalize on swing opportunities. Later on in the course, we will talk about exactly how to do those spreads, calculate risk reward, all that. That's in the options section. And I want you to keep your maximum part of your account exposed at once is 20 to 30%. So if you have a $1,000 Robinhood account and we get overnight, you decide to take an overnight swing or you follow along with one of my overnight swings, right? I want you to use a spread to have maximum 20 to 30% of your account exposed at any one given time, because overnight swings are risky and we have to prepare for that, especially when we're trading weeklies most of the time. All right. Okay, wow. Well, yep. I forgot that I had this this next slide here, right? So for a 2K day trading account, right, we have this maximum capital usage as $600 and a maximum position loss as $100. Ideally, I would love you to be trading contracts that are 2.0 and under. And really, I think the perfect number is 1.0 to 150, or actually we'll call it 0.80. 0.80 to 160, right? That sort of range. Because if you can trade a contract that's 0.80, you can trade 3 contracts, right? And that's not that crazy of a risk. That's $240, right? That's a little bit of less than 10% of your account, right? Or a little bit more, excuse me, than 10% of your account. That's reasonable, especially knowing that we use tighter stops. You're not going to let that 10% of your account go to zero or anything, right? So that's ideal because then that allows you to trim a little bit and take some profit off, raise stop loss to break even. 160 will allow you to do the same thing, right? Where you can take 2 contracts, right? At the absolute most, that would put you at about a $320 position size, right? That would still allow you to trim. So these are my ideal contract sizes, and it's got to, I think 2.0 under is crucial because you want to be able to have 2 depending on the setup, right? So that you can trim one and raise your stop and keep profits, right? So beyond that, I think that when we're talking about a small account, the other thing is we've talked a lot about psychology tonight, and guess what? We're not done. We have the loop conversation coming next. Although, to be frank, I might rearrange the order list a little bit and save the loop for a different presentation. That way, because we already talked about it psychology tonight, and I kind of want to talk psychology during every presentation, so keep the loop for a different one. We'll see. I might play it by ear here. Also, I love you all. At 6:30, I got to press send on that order. Please give me 1 second because otherwise I'll have no dinner. And I want to watch the end of the Warriors game with some dinner. I have it in the cart. Just got to press send. So we talked about withdrawals a little bit last night as well, right? But to me, this is probably like the most, I'll call it the, one of my secret sauces, right? Is my ability okay. Okay. I'm getting Korean fried chicken, by the way, everybody. Let's go. Okay. So withdrawing to me is something that this is what I hate to be that guy, call them real traders, but I couldn't be that guy. This is what real traders do. Real traders treat this like a job and they constantly withdraw their profits, right? So even you as a $2,000 account who one day wants to trade a $10,000 account, in my opinion, you should not try and take your account from 2,000 to 10,000. Right? Because the more, at least for me, this was my experience. This was my experience. I would take a $2,000 account. I'd get it up to 3 or 4. I'd be fucking stoked, right? But I haven't done anything too crazy yet, so I'm not too cocky. You know, this is the first time I've made money in a while. But I'll keep it in there because, hey, if I can go up to 10, that's great. I've been hot lately, right? So why not? So up to 3 or 4, and then maybe I go up to 5,000 out of nowhere, right? Course of a month, right? Next month goes on, a couple of small days here, a couple of days where I almost had a big tilt, but I saved it last minute with maybe like a 0-day expiration XPX or something. Saved it, right? But all safe, right? Then eventually get to like 7,000 or 8,000 and it crashes all the way back down to 3. Because at some point on a tilt day in your head, at least for me, I would say for me, it was always like, well, this is just profit. Right? When I started going on a losing day, I would start giving back a lot of my account's net liquidity. And I would just justify it in my head as the trade was happening by saying, well, it's just profit. Right? Even if I go all the way, even if I lose all the way back to 2,000, it's just profit. Right? I'll make it back. Right? And then afterwards, the day would end and I'd be back at 2,000 and I would be like, what the did I just do? Holy shit. But in the moment, you can't recognize that. Right? You really can't. It's just profit. Right? The worst words ever uttered. Because no, it's not profit. It's your hard-earned money that you woke up for and you worked for. Right? So for me, I treat this like a motherfucking job. I start with X and I withdraw the majority of my profits each week. Now, for me, for example, recently has been starting around 10K. That number varies based on overall market conditions. But for me, I'm withdrawing most of my profits at the end of a given day or week, right? Sometimes I'll leave, like I gave an example. I start with 10, let's say I make it up to 14. At the end of the day, sometimes I'll withdraw like 3, right? I'll leave 11 in there. I'll leave an extra 1,000 in there. That gives me sort of a mental buffer for the next day, so to speak, right? But the majority of my money is out, right? it's out, it's withdrawn, I'm cash, I pay myself. And for me, what this helps with the most is fighting the urge to size up, right? Sizing up is the most difficult part of evolving as a trader. It's incredibly hard. And you can ask any single one of the mods, any single one of the successful mastermind students, and you can ask me, anytime we size up, you know what usually happens? Wow, you get smacked in the face real and quick, right? That's usually what happens to everybody, because as soon as you size up, your expectations change. Right? You're taking a $3,000 position size instead of or for smaller numbers, you're taking a $500 position size rather than a $300 position size. So you expect more. So when you're up 20%, a 20% that you would normally take and be very happy with, all of a sudden it's not enough, right? Then all of a sudden you start to give back some gains. And for me, again, all of a sudden in my head, it's just profit, right? I'm just giving back my profit, right? And I hate that shit. So my advice to you all is, even as a $2,000 account, pay yourself. Withdraw, right? If you go 2,000 to 2,400 on the week, you just made over 10% of your account in that 1 week. And realistically, 2,000 to 2,400 is a reasonable number. That's not that crazy to me, right? That's like 2,000 to 2,400. You made $400 a week, 3 or 4 good days of trades and 1 no trade day or small loser day. That's really reasonable. And if you can actually do that consistently over time, oh, you're going to make so much. Okay, sorry, I see the chat blowing up, which usually means mute somebody, but no, okay. Okay, cool. Fighting that urge to size up is huge, 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 and incredibly important. And I want you all to take it very seriously, no matter how hot you've been, right? For me personally, I've had a good streak recently, had a few back-to-back weeks with some on cat. I'm still withdrawing it all. I know the minute that I say that I'm going to size my account up in a real way, right? Like for me, sizing up from 10K to 15K isn't sizing up. Like for me now, it would be like, okay, do I want to go back to my 35K account? Do I want to go back to like a 50K account or something like that, which I've done before. And I don't want, and I was successful with it, especially at the end of last year, but I'm not ready to do that yet, given the overall market conditions. Again, we're still in a weekly downtrend. This shit's not easy yet, right? It's not easy money yet. We're not back to the trending days yet. So me fighting that urge to size up, I think, is actually one of my most positive traits as a trader. And I want to instill that in you all from a very, very early stage, right? Okay, so with that, let's talk about some names that you all can focus on as a small account. What we will do, Ali has a very specific small account watch list, and I will also copy and paste this right now into the mastermind chat so that you all can save it. I just did that right now, but there is our small account focus list. If you are a small account, these are the names that I would put on your watch list and be stalking them every single day, right? You have your tech stocks, AMD, Apple, Snapchat, and QCOM. Those are my favorite kind of small cheap movers. I'm sure there's some other great ones on this list. I know Mike is on at the moment. He can feel free to throw out some others that he focuses on. But from a banks, I like MS and BAC. Those are cheap. JPM is actually a great one too for small accounts. I'm going to replace. I don't know why MS is on there. I don't trade MS. I trade JPM. Industrials, CAT, and Boeing are great small account ones. Boeing is a little bit more expensive sometimes, but usually reasonable. And then miscellaneous, I like RCL and Plug. Really, Plug is a great small account mover, very cheap contracts, very reasonable types of trades. All right. So I believe this is our last small account slide, and we won't spend too much time on it because it's more psychology, and I feel like I've already preached at you all enough tonight. But the reality is that small accounts are 99% mental. They're mostly discipline based, right? In order to be a successful small account options trader, I genuinely believe that you have to be, and when I say successful, I don't mean you just took one port and tripled it. I mean, you are consistent every week, every month, growing with not that much cash, with $5,000 or under, growing and withdrawing consistently for months on end, right? Like I'm not just talking about YOLOing and making some money. In order to be a successful small account trader, you have to be one of the top 5% of disciplined people on earth, right? Like that's what it takes, because as small account traders and as options traders, all we do all day is examine opportunities to make money and make stupid amounts of money, right? Like we examine opportunities where we're looking to make 100% returns on our capital, right? Like what? Nobody offers 100% returns on your capital unless it's a super high risk fucking investment, right? But like we are staring at hundreds of opportunities a day. So in order to control your emotions and remain disciplined during that, it's extremely fucking hard, right? It's even harder when you only have so many bullets that you can stab, right? So reality is that your small account is not, it's not the capital that's holding you back. It's your ability to remain patient and disciplined, right? Whether you have a large account or whether you have a small account, the ability to be consistent in your trades and execute them well is all that matters. It truly is. It's all that matters, right? That is what is going to separate you from those who consistently blow their accounts is, can you be focused on consistency and execution and not the dollar value? Spoiler alert, none of the money that you're going to make from your $1,500 account is going to be substantial for your long-term net worth if you end up being a profitable day trader, which I'm expecting every 40 people who are on this call right now to be, right? So if you are, the money that you're making from this $1,500, $2,000 account, I'm sorry, it's not going to be substantial to your end life's net worth. What it will be substantial to is building, unless you get lucky on some shit, crazy percentage return, and then you can, but for most people, it's not, right? What will actually contribute to your long-term net worth is the habits you build while you're trading that $2,000 account. Because if you build good habits while you're doing it, and you're consistently able to make money and pull some small money out, or when you're ready, add in separate funds that aren't profits to increase your position sizes, right? The habits you built will contribute to your long-term money, right? So you have to understand that we're playing the motherfucking long game here as much as possible. And that right now, especially throughout the course of this mastermind, your habits are significantly more important than anything else, right? Anything else. You have to focus on the habits, right? The last message I want to point out on this is, do not spread yourself too thin, right? Meaning that you just have eyes on too many different trades, you're watching too many different tickers, you're focused on the P&L chat in the room, right? As opposed to being laser focused on our goals as a small account day trader, which is 1 to 2 good trades per day. Then you get away from the screen before you can debate swinging or anything, right? You do that every single day, and I promise you, your account will compound even after you take withdrawals to pay yourself, right? I promise. I promise. Okay? All right, let me check the chat real quick. Yeah, I see a few good questions in here, and I see Ron and Mike. Thank you both. I really appreciate you being on. So, and then nothing else that seems super immediate. Okay, cool. So with that, we're going to dive into lesson 3 now, right? Again, right, I planned this out as 10 lessons for the previous mastermind class. We are doing ours condensed into 8, but we're going to cover all the same material. So we're going to move into a little bit of lesson 3 now. Now, I am going to make the executive decision that it is 6:40 p.m., right? We are not going to cover the loop today because I've already covered a crap ton of psychology stuff with you all. And I just don't want to beat the dead horse too much in one session. The reality is I have to beat a dead horse. I have to drill this stuff into your brains because I want you all to memorize it, right? And truly have it drilled into your brain. But we've already been talking about it a bunch tonight. So we're going to come back to the loop at a different time. Maybe we're going to save that one for when we need it, right? When we've all had a tough day or a tough few days in a row, we're going to talk about the loop, what it is and how to get the hell out of it, right? If you do want to talk about the loop earlier, bring it up in mastermind chat. Well, every single one of us has been stuck in the loop. We'll be more than happy to break it down for you. Okay. But with that, let's dive into technical analysis just a little bit. And what we're going to do is cover about 3 or 4 slides. And one of these is actually a review slide. And then we're going to dive into the charts, and I'm going to break down some of what we talk about right now on an NVIDIA live chart and kind of cover the stuff that happened today as well, right? So for those of you who are more in the part of our classes, again, within our class, we have some people who are newer to trading and some people have been doing it for a year or 2. For those of you who have been following along and all the technical stuff that we've talked about so far, the super basics, you're like, man, is this all we're really going to learn and stuff, all blah, blah, blah. I promise you, bear with me. Tomorrow or next Tuesday is when we dive into buy and sell setups, which if you're here, it means you haven't learned them in the past, right? And Thursday is when we're going to talk into levels. So we're going to get into the more advanced specific stuff tomorrow. Today, what we're going to do is make sure that we're all on the same page about we're all on the same page about what technicals we even look at in general and such, right? So, okay, last check of the chat before we dive in. Just scroll through the slides so I can read later, please. What do you mean? So you can read? Well, you have a chance to read all the slides. Yeah. Okay. I don't understand that. Okay. Okay. Oh, the loop one by one. Oh, okay. I got you. Okay. You know what I'll do, Andrew, is I'll post them. I'll post. Oh, that's a great point. My bad. I was confused on what you're saying. I'll screenshot and post them. I'm on it. Thank you, sir. Good point. Perfect. Okay. So, and we'll talk about that in Mass Chat too. I want to just save that now because we just talked about psychology. All right. So, technical analysis. What is it? You all know what it is, right? Technical analysis is the technical analysis is pretty much. I looked up a couple definitions. And I was like, fuck that. It's the use of charts to interpret data. That's what it is. Technical analysis is us looking at charts. Those charts present ideas and patterns to us, and we look to execute upon those patterns, right? So how do we use technical analysis? In its most basic form for me, what I do is I use longer timeframes to identify the best opportunities, and then I use smaller timeframes to find entries on those opportunities and manage the trade. Every single one of the trades that I take has some sort of thesis relating back to the daily, weekly, or hourly chart. Very rarely, if ever, do I ever take a trade that does not have some sort of correlation to what is happening on a longer time frame. The smaller time frames for me are just from entries and management. And I think that's really key for people to understand. Okay, so this is my favorite slide of this presentation because I love this analogy more than anything. For those of you who follow basketball, especially a little bit of old school basketball, this will make a ton of sense. For those of you who don't follow basketball at all, I'm going to break down exactly what it is and why I use the triangle offense, right? So for those who aren't familiar with basketball and aren't familiar with basketball, right? Let's assume everyone's familiar with basketball. Teams will traditionally have some sort of offensive system, right? They'll try and dribble down the court and they'll do something to score against the defense, right? Now, I coached a lot of basketball when I was younger. And one of the things that I think, happens when you're in the young stages of your coaching or young stages of basketball or young stages of your trading, right, is that you come in with what we call as set plays. You come in and you try and do something no matter what. Right? You come in as an offensive system, you dribble down the court, you pass the ball to the side, and as soon as you pass the ball, everybody knows before you even come down the court, everybody knows what everyone's going to do it. It's a predefined plan. You are forcing that upon the defense. You are telling the defense that we are going to run, this is what we're going to do no matter what you do, right? It's a very strict set play. It's defined, right? And as traders, I think that a lot of people in their early stages of their trading career get sort of stuck into this, especially with indicators, right? Is they're like, when the 9 crosses the 21, I buy, right? And it's like, that's just not the way trading works, at least in my opinion, in my experience, right? But in the 90s, in the early 2000s, a guy by the name of Phil Jackson started using this offensive system called the triangle offense. And it is what Michael Jordan and Kobe Bryant played in, if those names ring a bell for those who aren't familiar with basketball. And basically the point of the triangle offense is it is reactive to what the defense is doing. Now, you have a set of rules and principles that you operate on as you come down the court. But when they pass the ball to one side of the court, rather than having a set definition of what they were going to do, it would be largely based on what the defense was doing, and they would follow a set of rules. Somebody dribbles to the corner, somebody dribbles here, we rotate here. If they do this, we do this. If X equals Y, it was a reactive offensive system, as opposed to a set play, a hardcore sort of set, confirmed definition, this is what's going to happen. And it was a reactive set of rules. So the triangle offense has a defensive system built in. And I think that's sort of a huge portion of it, as well, is that when the triangle offense would come down, run their sort of plays, they would naturally come down and fall back in a specific defensive formation. Again, relating this to trading, offense is defense. There's going to be times to be on the attack as a trader, and there's going to be times to be very specifically defensive, right? Which means that within my strategy, There's built-in defense mechanisms. There's built-in defensive systems built in, not unlike the triangle offense, right? So for me, this is how I compare and this is how I analyze as a trader, is that I am analyzing what is happening with a reactive set of rules, with a system around of what I'm allowed to do based on what the defense, aka the market, the chart, is doing, right? That's how I operate. So we as technical traders operate by a certain standard of rules, right? And we're going to cover all of these rules much more in depth as we get into the, the next few lessons. But we'll cover them all right now as well, just for noting purposes, right? So a couple of the technical rules that I want you to always understand is that markets are always either trending or ranging, right? And on the most basic and core level, basically what this means is that the market is always either stuck going sideways, meaning it's ranging, it's consolidating, or it has some sort of uptrend or some sort of downtrend formed at the moment, right? Like formed in time, and it's actually trending. If not, it's not. Those are the only two options: sideways action or a trend. There is no other option, but we have to identify what is happening on that chart before we look to enter a trade on it. Is it ranging or is it consolidating, right? So that's what leads us. I'll add that as a question. Is it ranging? Is it trending? So another one of our rules that we've had, and we have talked about this a lot, is that when a candle, as a technical trader, we look at a set of candles, right? And when one candle breaks the high of a previous candle, or when one candle breaks the low of a previous candle, in theory, it should get continuation in that direction, right? With that trend, it should continue, right? So again, we'll talk about that much more once we actually dive into the charts, but this is one of the rules that I want to make sure you all have marked and noted down. The other one is that candle analysis, and actually I'm going to restructure these really quickly and move this one up because this one makes more sense as a little bit of a note right here, right? So let me revert back because I got myself out of order there, right? So we talked about the previous candle high or low break should get continuation in that direction, right? But when it doesn't happen, that leads us to these failure setups that we've talked about. And this quote here that I absolutely love, which is that when what should happen doesn't, take that as a clue. Hey, if we're in a bear flag and we break down and then immediately reverse back to the upside, that's a clue, because that bear flag, based on what we all know as price action traders, we know that bear flags typically mean things go down. So if that's not what happens, we need to take that as a clue, right, informing our overall story into our triangle offense approach. When we're making a decision on what to do, right, we are reactive by saying, okay, hey, I was watching a bear flag and it failed that breakdown. That gives me a potential trade in the other direction. That's the exact basis of the SPY trade that we took yesterday. It was a failure trade, right? So this all comes back to the systemic approach that we have, right? Excuse me. All right, 6:50, we're doing good on time. Probably go not too far over the 70, 80 minute mark tonight. 60, 70, 80 minute mark. Won't keep you all for too long. We can get you all back to the NBA game and you can rewatch this 100 times, searing into your brain. So the other two rules that I have, right, are that candle analysis is applicable on all time frames. And that to me is like, oh man, when I learned that, I got so excited because what I did for the first, I don't know, 2 years of my trading career was stare at 5-minute charts. I was on my computer all damn day. I was doing on demand on the weekends. I was staring at 5-minute charts. I actually think that was a bad thing that hurt my trading because I was too focused on the charts and stuff, right? But for me, I have stared at so many 5-minute charts that I recognize like how so many patterns on a 5-minute frame, like in so many, like for me, I'm really good at predicting what will come next from a candle perspective because I've stared at a lot of 5-minute charts. And that is like a huge portion of what I will do then on a daily time frame to catch a move like NVIDIA today, right? Because I'm familiar with how that price action looked on the 5-minute chart, is all still applicable to the daily chart, right? Any patterns that you see on the 5-minute chart are still valid patterns if they're on a daily chart. The only difference is how do you trade those patterns, right? If it's a 2-minute pattern, it's probably a scalp, right? You're in, you're out, you're not doing that. If it's a daily pattern, you might be looking at a swing trade, right? You might be looking at giving a little bit more room on the stop, right? Like there might be all these different factors sort of in play, right? So another one of our rules is that candle analysis is applicable on all time frames, right? All time frames. And the last one is that as my favorite, that's not true. All of these have been my fucking favorite. But the markets move from level to level. When I first learned the level system that I used from Eric at Major League Trading, it changed my life. And you all kind of saw it today with how the SPY and ES moved. It moved very much from one level to the next level. That's went from 40.77s 50s to 41.57 halves. And like that was it. It was from level to level. The markets have a purpose. The markets isn't random, right? No matter how much you can think it's random, no matter how much in the past people have told you, oh man, this move makes no damn sense. This is this, blah, 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 blah. Everything has a purpose. The market is always doing something intentionally. And yeah, there's going to be choppy days and there's going to be fake outs and all that. But those fake outs are usually part of like a larger time frame failure, right? Or something like that. Man, NVIDIA failed a breakout yesterday. Why did it break? Why did it fail that breakout, right? Like blah, blah, blah. It's like, no, it's just that the NVIDIA needed to retest this level before it ended up making that breakout, or it needed to do X, right? Or it needed another day of rest before it made that breakout, right? But the everything that we see is explainable. And that's why I love this technical analysis system more than any one that I learned previously, is because everything is explainable. Everything's rational. There's some sort of explanation as to what is happening on all levels, right? Because a pattern is either succeeding or failing, right? It's succeeding or failing. We can use that failure as a clue, right? Okay, I'll pause here and check because we have 10 questions popped up. Okay, everything looks pretty good so far. Eric learned from a guy named Rob Shapiro, from Bar by Bar, and then a guy named Rob Shapiro. I have no idea who Rob Shapiro is, but he learned the levels from Rob Shapiro. Really good trader though. So, okay, moving on. Let's wrap up. Well, Andrew, I give Eric credit for the level system. That's what Eric taught me a whole lot, and not just levels, but the levels was the main thing. The Bar by Bar book is what kind of took me to my next level, and I kind of created my own system based off of that. But in terms of where I get my support and resistance levels, yes, they're the same as Eric from Major League Trading. And I'll always give him credit on that because I didn't invent the level system. And then, okay, Kendall, yeah, I would, Kendall, so next week, we go right into buy and sell setups in the level system. No, we're going to cover it. Don't worry. Yeah, we're going to cover it in ours. But I just meant that like the guy who taught me how to get the levels and originally was him, right? So don't worry, we're going to cover it all, right? I'm not holding anything out on you all. But yes, I do recommend reading the Bar by Bar book 100%. What I would say in that book is you can skip some of the emphasis on trend lines. Don't worry about that. For me, I didn't pay attention to much when it talks about trend lines. But yeah, okay. All right, so let's finish up these last few slides, then dive into the chart a little bit. Right? We'll just review NVIDIA and then we'll call it a night. So we talked about this last time, right? Some basic principles of support, or excuse me, some basic explanations, definitions for support and resistance, right? So we're not going to cover this again right now, but what we are going to do is cover our support and resistance rules. There are certain rules to support and resistance, and really what I'm going to do right now is change this for the rest of times to levels rules, right? Levels rules. Because a level, as we defined in the last time, is not binary support or binary resistance. A level is something that we can watch for a reaction off and then trade accordingly, right? It can be used in either direction. It is not binary, and I hate that, right? So there are 3 rules that I established, and you might hear us sort of talk about them in the trading room from the first mastermind class. But there are 3 that are, well, everybody might have learned this in the past, but until you give them a fun name, and then until you start using it as a piece of your triangle offense system, you just learn the definition. You're not actually using it, right? So the first rule is the knock-knock rule, right? The more times that a level is tested, the more times it likely breaks that level, and it breaks with power. So the reason I call it the knock-knock rule is that if you knock enough times on the door, somebody's going to answer eventually, right? So if you knock enough times on resistance, that is going to break eventually, right? If you knock enough times on support, it's going to break eventually, right? So the more tests you have of something, the more likely it is to get follow through, right? So if you're looking at an hourly resistance level and it's been tested 4 times, the next times it breaks, as long as all other things considered equal, I would look for that level to get a break, right? And if it doesn't break, I would say that it's less of a level and more of a range top, right? Where we have a defined range top and bottom, where it's just stuck in a trading range and it might take 10 tries before breaking out of that trading range, right? So that's called the knock rule. Very, very important rule to me that you all understand the principles of the knock rule, right? The second one is my personal favorite of these rules. It's called the Uno reverse. The Uno reverse. Now, Uno reverse can be used as kind of a phrase of all, a jack of all trades, a phrase of all trades, right? Or whatever it is. You could, Uno reverse could be like, oh, I was up on my trade and the Uno reverse on me, now I'm down, right? But in terms of support and resistance levels, the Uno reverse principle is one of my favorites. We're going to talk about it because it's one of the reasons I was long NVIDIA overnight, is because of the Uno reverse. When a resistance is broken and then we come back to trade back to that resistance, in theory, it should act as support when tested, right? When a support is broken, that previous support should act as resistance when retested. Now, the reason I have should marked out there is because most people just say that it is. Old support, old resistance becomes new support. And it's like, no, that's not fucking true. What if it fails? What if old resistance then fails as new support? Then guess what? We have a failure setup. Boom, it all makes, there's rationale, there's reasonable. That support setup, that knock should have worked. The Uno reverse, excuse me, it should have worked, but we had a failure setup. We failed all that support. There's rationale, right? But the Uno reverse principle is one that you will find yourself using all the time, especially as a with trend trader. Love the Uno reverse. Then the last one is look, I couldn't find, if any of you have a more creative name for this one, it was something that was like, look my body or something. I don't know. I don't know. I need to come up with a better name for this one, but basically, I'm more worried about the bodies of candles rather than the wicks, especially for support and resistance levels and when I'm creating them, right? The wicks are good visual representations of a test, meaning that if we have a level at 190 and NVIDIA wicks 190, that wick to me does not prove anything other than the fact that we just tested our 190 level. It doesn't form a new level. It's not jack shit. It's just a test. It's a visualization of a test, right? Then this is just for forming levels, not for entries and exits, because there was some confusion on this last time. We'll talk about that next time. But for forming levels, I like to use the bodies, right? Use the bodies of candles to determine where was price accepted, right? Where was price accepted? So if we have, and we'll dive into a chart in just a second. Actually, right now, we're going to dive into a chart. Just right now. So give me 1 second. I got to pull up TradingView on another screen here. Let me see. Have I switched to TradingView? Can you all see TradingView now? Okay, cool. So we can now flip back and forth between these two, right? So and let's look at a real life example of some of the principles that I was talking about, right, on some of those former rules and apply to how we considered that for a trade yesterday, right, which was this NVIDIA long, right? So if we look back on what was happening on NVIDIA's daily chart, we were in a strong downtrend, a strong downtrend, new lows, but here we rally up and set a pivot at some sort of resistance there. Extra brownie points for those that recognize that we trigger a sell setup right there. But with that, this day becomes a previous little reference point, right? Now, it's not a specific level. My specific levels will come from the hourly chart. We'll get into that next week. But I use daily zones and such, not as specific, but just as reference points, right? It's a reference point. What is the principle here? The daily chart broke above a previous lower high, right? It broke above a previous area of resistance of supply, right? Now, again, the specific level we would be watching for would come from the hourly, but by breaking over this and now pulling back towards it, the Uno reverse principle is in play, right? Uno reverse, because that resistance area, that level, that supply zone has now flipped. Spoiler alert, all those things just mean the exact same thing. right? That has now flipped, and all of a sudden we can start to apply Uno reverse principle, right? And start to say, hey, okay, I'd like to look at longs holding this previous former high, right? I'd like to see and use that as our reference point, right? So another example on this chart that I think is important to talk about is the knock-knock principle, which is right here, right? NVIDIA had a support level down at the, again, the specific level would come from the hourly, but there's a zone of support here from around like 210, right? Around the 210, 200 area, right? And that zone had held 1, call this 2, 3, 4, 5, 6, 7, 8, 9. 9 days of actually touching that zone, right? So if we review our first principle here, knock, knock, the more times the level is tested, the more likely it eventually breaks. I should say that. The more likely it eventually breaks and breaks with power, right? NVIDIA, when it got that break below 200 and the 210 at this area that we've been testing for a while, it was harsh selling, right? It did have a little bit of consolidation here, but this is a very clean and strong downtrend that ultimately gets a rather large move down. 200 to 160 is a big move for a stock that price, right? That's a large percentage move down, especially something that's already down so much, right? So here's an example of a knock-knock principle on NVIDIA where we tested this level, this area 9 times. And when we eventually broke over, it broke down beneath it. We never even came back for a retest yet. We just slammed down through the lows, right? And slammed down through with a big move down, right? So this is just one example of many that we could talk about when it comes to the knock-knock principle, right? Meaning that the more times you test the level, the more times it is likely to eventually break and break with power, right? And I saw a question pop up there from Kendall at the time, which is, I see your question about TradingView, Mike. Let me answer that after this. After on, we'll talk about that in the chat. Kendall, yes, this is the daily chart, but again, it doesn't really matter, right? Whether it's the daily, a 5-minute, the time, and I have really cool examples on our next slide, our next lesson for buy and sell setups. Some are 5 minutes, some are weekly, and you won't be able to tell the difference. All that matters is the candle pattern that we're seeing, right? So this was the daily, but it doesn't actually matter. You know, you could have a knock-knock on the 2-minute, you could have a knock-knock on the 5-minute, right? So is the time frame for knock-knock test the same as where the level will come from? So no, Gabriel, so the levels will all come from the hourly. Knock-knock is one of our general support and resistance principles that can be applied on any time frame, right? On any time frame. But I think I know what you mean by that, by saying that like, it's the same idea as like, if you're watching a knock-knock on the 2-minute, it's going to be a 2-minute scalp or like a 2-minute type of trade, right? Like don't expect a 2-minute knock-knock type of breakout thing to then be like a month-long swing trade, right? It's like, no, if you're looking for a knock-knock on the daily chart, you're more likely to use that for a swing trade than you are a knock-knock on like the 5-minute, right? And again, a knock-knock, let me just say this, a knock-knock is not like the strategy, like I'm never going to take a trade and be like, oh, what was that trade setup? Oh, it was a knock-knock on the 5-minute, right? It's like, no, this is one of like 20 pieces of our offensive triangle system, right? So don't leave this lesson trying to trade the knock-knock or the Uno reverse or anything on their own tomorrow. This Uno reverse was not the only reason I took this NVIDIA trade. That was not the setup. That was not, yes, there's so many other factors, but that is one of our pieces of the puzzle. That is a excuse me, that is a piece of our triangle offense, right? And it's a huge thing to understand, is that all we are trying to do as price action traders is interpret piece by here, piece from there, piece from there, piece from here, and tell us, okay, what is the overall story based on all of this information that we have, right? All of the information that we have in play, right? And sort of at our disposal, so to speak. Okay, let me see what some of these questions say, because that was really the main ones. And then what was the third rule? Yes, I saw the question, and I'll post these slides. I have these ones. I'll post these slides in your recording section right after today's lesson. So you'll have access to all of them. But here are the rules again, you can screenshot. And the other one, just from our three, just to show all of these, is that I am going to be focused more on the bodies than the wicks, right? Like, so for example, one of the NVIDIA levels that we had on watch today was Monday's open, 189.8, right? 189.80 was the watch for level. So if you missed the swing trade entry and you missed earlier entries on buy setups or whatever the case may be, right? For me, I would have been paying attention more to the body here, right, as a level, and that also comes from the hourly, than I am the wick, right? The wick to me is excess. It's less crucial, less important than the body. Again, I'll clarify a lot of specifics on that, because when we do entries and exits for buy and sell setups, that's when the wicks really, really matter. So we'll talk. Don't rule out wicks. They matter for entries and exits specifically. They are very important for our signal bars. But in terms of finding levels and in terms of support and resistance areas, I'm very much less concerned with the wicks than I am for the bodies, right? So those are three rules for me. They're the three rules of support and resistance that I think you kind of have drilled into your system. That I think you kind of have drilled into your system. And understand that in our triangle offense and in all we're trying to do, and this is the part, is we are trying to understand how the charts are moving, right? And understand how can we anticipate what might come next in future situations, whether it be a 5-minute future situation or a daily chart future situation. Understanding these principles of support and resistance is a huge, huge portion of it. And for me, giving names to them was like necessary for it, right? Necessary, right? So those are my rules and principles, right? And that actually kind of brings us to a close on the information that I had that I wanted to cover tonight. And I saw we had a few questions in there, and we do have a few minutes before we'll wrap up, so I'll more than happily answer a few questions. But one here from Kendall was, okay, so since we missed the swing, we could have zoomed out and still saw a net entry for a day trade. Would have been a day trade setup. Absolutely. And this is where, for me, I kind of wish I had signaled a new day trade, but I'd already signaled a swing. It's a slippery slope, because I don't want to force people. I don't want to pressure people into oversizing a particular position, even though it would have worked today. But if you missed the swing, this was absolutely a day trade setup, and it's a day trade setup in a few different ways, right? You could have drilled this down, and to me, the first real entry isn't until you have to drill down into a 2-minute time frame and take a 2-minute buy setup or a 2-minute sell setup failure, like right about here. But this gives us an opportunity. We also actually had a level at 187 something, I think, too. But you do see that we have really nice price action around this 189.8 level, right? So it would have been valid. Now, understanding that this was a swing trade for me, the 189.8 was more of a target than it was an entry break, right? That being said, if you weren't in this trade, you could have used this level to find an entry. Now, I would, and we'll talk about this especially next lesson, because we're going to talk about buy and sell setups. I would not have you buy the breakout of this level. That's why sometimes you'll see me say stuff like, oh, I'm watching this contract, and then you'll see it'll start to actually go in our favor, and I would have made money had I entered right then and there. Right? Like if I had not been in a day trade or swing trade on NVIDIA, and would come up to this level, right? And my game plan was, okay, I want to watch it over this level for longs. I'm not buying on the break of this level. I'm not buying here, right? I'm not buying on this particular break right here, especially given all the other circumstances. I can't buy a breakout on that. But if we pull back and get some sort of price action, developing us with some sort of consolidation, some sort of more data on that chart, then now I can use that same level as my reference point for a new entry, either here or maybe somewhere down in here, right? But the reason I'm not buying the breakout is because breakouts of levels usually are not the best of entries, because a lot of times breakouts fail, right? And I'm sure if you've been a breakout trader, and I'm sure that if you've been a breakout trader, you've experienced a lot of that. And today is a great example, right? If you bought this breakout, you probably got cooked and you probably even got stopped out. But the main reason is, Tony is the one who asked that, I think, if you buy this breakout at this level, where do you place your stop loss, right? Where is your stop loss on that trade? I guess technically you could have it right here, but this isn't really a pullback area. This is just, we just move sideways before it keep going up. You want to have a reasonable place to put your stop loss beneath some sort of higher low, generally speaking, right? So for me, if I'm buying above the breakout, my trade is actually still valid until we break that lower box, right? Which is down here. So now all of a sudden, my stop is like $3 away from where I'm buying, and that's too far away, right? Now, you could wait and see if we had a successful retest of this level, right? Which is kind of what I'm doing. But I'm more waiting for consolidation and price action around that level to give me some sort of buy setup and entry, right? For me, where I would have entered this one today on a video would have come from a 5-minute chart. And I was actually stalking it around this time because I was in the swing trade. But I would have taken an entry either right here. Right there. On this 5-minute candle right about here. Or right here. Either one of those are valid entries, and we can't break down all the buy and sell setups right now because that's the next lesson. But the main reason being is that because then I can have my stop loss beneath here. If we break beneath there, right? If we break beneath this area, all of a sudden we've gone into a 5-minute downtrend, right? Because we're not holding higher lows anymore. If we fail to hold this area, we are no longer holding higher lows. We are in a downtrend. That's a valid reason to close that position. That's a valid reason to close that position and exit it, right? So for me, rather than buying a breakout up here and keeping your stop there, I'd rather wait for the pullback and buy the pullback, right? That to me is the more efficient way to go about that and tighten up my risk, right? All right, is that a level or just consolidating on the 5-minute? This is a list. It was a level up here. Let me see. For gaps, you consider the start of the gap at the body or the wick. The body. For gaps, it's the body. Body for me. Oh, well, actually, and now I see what you're saying. Like if you're talking about a gap fill, like if something comes and fills a gap, I don't know. That's a debate that's been had since the beginning of time. I used to even have a friend that had 2 separate names for him. He had 2 separate names for him. He would say that if it filled the wicks, if the wicks touched, that was like an air gap fill, but the body's touching is a technical gap fill. I don't know. I don't pay attention to gap fills all that much. So for me, it's just like wick to wick, right? Like if you touch the high of the previous day, that's good enough. But you can also watch for it to pull back to the actual body as well. That's a debate that's been having, they've had for the rest of time, for the end of time, since the end of time. I have no specific real answer for you on that. I would say I use the wicks more so than the bodies, and maybe use this SPY chart as an example. And maybe you could say, hey, maybe that's why we're so bullish today, is because we pushed down in here and we failed to go down and really fill that gap, right? We just kind of came up short. We front ran it, which is what gave us the bull strength to push back above. Okay, let me go through some of these other questions. And again, I'm just gonna do 1 or 2 more questions because we'll meet tomorrow and kind of have a point. If we're gonna meet on Zoom tomorrow, we'll be able to answer some of these ones as well. So let me see if there's any other questions that I can answer that aren't, diving right into the next lessons. How do you differentiate between a pullback and consolidation? It just depends, because those can be this one and the same, right? Like here on NVIDIA, this is a pullback from the highs, but it's consolidating sideways, right? So I think that to me would kind of be the same. That's a tough question to give like a really specific answer on. But in our next lesson, what we're going to do is talk a little bit about multi-time frame analysis and how that comes into play. I forget which lesson that one comes in. That one might be 6, actually, honestly. But yeah. With that, though, everybody, this was a very dense lesson, a lot of slides before we dove into a little bit of the charts. Again, I don't want to get too ahead of ourselves in terms of talking about buy and sell setups, right? Yeah, like Mike is saying right now in the questions box, the multi-time frame analysis will really come about. Will really be kind of clear up, whether we think something is going to trend or range, right? No problem. So Yeah, Julian, I see your comment that I'm realizing it's all about waiting. I can't emphasize that enough, right? It really is all about waiting, because if you had bought the first 5-minute close over this level today, you would have been buying into an inverted hammer, at the highs and kind of been getting trapped, right? As opposed to a pullback, we would have just a much better risk reward, right? A much, much better risk reward. Okay, gang. I know you all have a ton. You all have questions. Bring them tomorrow. We'll do more. We'll do more questions. What's it called? We'll answer some more of these questions. What we'll do tomorrow is, I'm not positive on the time yet, because it depends on what the trading action is like. But have questions, post them in the questions channel. I'll pin them. I'll have them saved. I'll make sure to go through and answer them. Try and keep them not buy sell setups, not levels yet, just because I promise we're talk about those next week, right? So for those of you who this was all pure review, I promise that you will. I promise that next week is when we start diving into like the thicker, juicier, more advanced stuff. So I appreciate you having bear with me through the beginning stuff. But again, how I use the basic stuff is not the way that most people use the basic stuff. So it's really important to cover. All right. Yes, everybody, everything is always recorded. And if I forget to record something, I will re-record it, or yeah, but I've never forgotten to record a lesson. So don't worry about it. Everything will always be recorded. Yeah, Andrew, the buy and sell setups, I'm excited to dive into those next week too. Those will be great. Those will be really key for all of you. So with that, I hope you all have a great rest of the night. This was a great lesson, and let's talk soon. Amazon to 50. Yeah, Amazon to 10. We'll talk soon. Go Dubs. Yes, go Dubs. Oh, hold on. First, before you hop off, I've been told Ahmed keeps yelling at me. I need to get more videos of you all in the chat. So just, if you're still around and you can type yeah or yay or woo, or you're happy with the lesson, just send it. Let's go. Great lesson, everybody. Hell yeah, team. I love you. Thank you guys for doing that. Just helps me out a little bit. I fucking love it here too. Thank you all very, very much, everybody. And we'll talk very soon. Okay. Have a great night. We'll get this recording posted up within like an hour. So it'll be up there, so you can re-watch. Cheers, team.